Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Abcellera Biologics Inc. quarterly report. Abcellera Biologics Inc. offers a range of businesses and services that cater to the discovery and development of antibody-based medicines. The company's primary focus is on developing treatments for indications with unmet medical need in the United States. One of its key areas of expertise is in the creation of non-hormonal medicines, such as Abcellera, which is currently undergoing Phase 2 clinical trials to treat moderate to severe vasomotor symptoms. Additionally, Abcellera Biologics Inc. has a fully human, half-life extended monoclonal antibody, Abcellera, that is being tested in a Phase 1 clinical trial for treating T-cell-mediated autoimmune conditions like atopic dermatitis. The company also engages in research collaborations and license agreements with prominent pharmaceutical companies such as Eli Lilly and Company, AbbVie Inc., and Biogen Inc. Furthermore, Abcellera Biologics Inc. has partnership agreements with investment firms Viking Global Investors and Aeromark Partners. These partnerships enable the company to leverage expertise and resources from various stakeholders to accelerate its research and development efforts. Overall, Abcellera Biologics Inc.'s business model is centered around developing innovative antibody-based medicines through collaborations and partnerships with leading pharmaceutical companies and investors. Abcellera Biologics Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Abcellera Biologics Inc. trades at a lower price-to-book ratio of 1.63 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 29% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. If the business does not improve its revenue and generate positive cash flow, the company will continue to struggle to cover its cost and interest expenses. This combination makes the investment case highly unfavorable unless earning issue is addressed. On top of the cash-burning business, shareholders are consistently diluted. I may be wrong, but I would suggest to stay away from such investment for now. The primary drivers of revenue growth or decline can be categorized into several key areas. Revenue growth is primarily driven by research fees, licensing and royalty revenue, and the successful development and monetization of drugs. The company's partnerships with other organizations also contribute to revenue growth through milestone payments and royalties. Additionally, interest income from cash management strategies and the advancement of internal programs in preclinical and clinical development are significant drivers of revenue growth. On the other hand, revenue decline is often caused by delays in clinical trial completion, regulatory approval issues, and changes in regulatory requirements and policies. Manufacturing process or facility rejections by health authorities can also lead to a decrease in revenue. Furthermore, unfavorable feedback from health authorities regarding safety, efficacy, and purity of drug candidates, as well as adverse events in clinical trials, can negatively impact revenue. In summary, the success of a company's revenue growth or decline is heavily dependent on its ability to navigate the complex regulatory environment, manage partnerships effectively, and ensure the successful development and commercialization of its products. The net income of the company has experienced significant fluctuations over time. Initially, it decreased due to substantial legal and financial compliance costs associated with being a public entity. This trend is likely to continue as the company faces potential securities class action litigation, which may further decrease its net income. Profit margins have also been uncertain, threatened by various risks such as failure to execute business strategy and competition for more effective or less expensive therapies. The company's net losses in 2025 and 2024 imply negative profit margins during this period. Furthermore, increased costs, including compliance expenses, reduced insurance capabilities, and potential diversion of management's attention and resources, may also contribute to a decrease in profit margins. The company's financial performance indicates a concerning trend in its operating cash flow. For both years, 2025 and 2026, the company has reported negative operating cash flow. This means that it is using more cash to fund its operations than it is generating from those activities. In 2025, the net cash used in operating activities was minus $11,554 million, while in 2026, this figure increased to minus $33,523 million. These numbers suggest a significant decline in the company's ability to generate positive cash flow from its core business operations. This trend is alarming and warrants further investigation into the underlying causes of these negative cash flows. The persistence of negative operating cash flow over 2 consecutive years raises concerns about the company's financial stability and sustainability. It may indicate inefficient use of resources, poor management decisions, or other underlying issues that need to be addressed. The recent market analysis reveals a mixed performance across various regions and segments. In terms of poor performance, international markets have struggled due to several factors. Firstly, the EU has faced challenges stemming from political, economic, and regulatory developments, which have hindered growth. Additionally, international markets have been impacted by varying reimbursement and healthcare payment systems. The United States, Canada, Australia, and European Union regions did not provide specific information about their performance in the extracted summaries. This lack of data makes it difficult to assess their market standing. Management is optimistic about the company's outlook, citing several key strategies that will drive growth and success. The primary focus is on investing in research and development (R&D) efforts to enhance technology and platform capabilities. This includes building a pipeline of drug candidates through its discovery and development platform. The company plans to prioritize partnerships and internal discovery and development of new drug candidates, as well as acquire technology and form alliances/joint ventures to further expand its capabilities. Additionally, management is committed to focusing on antibody drugs and improving discovery and development capabilities in this area. While the company acknowledges potential risks associated with tariffs and trade disputes, it appears confident that these challenges can be managed effectively. Overall, management strategy emphasizes a commitment to innovation, growth, and strategic partnerships, positioning the company for long-term success. The company's stance on shareholder returns is clear and direct. According to their official statement, they do not plan to distribute any dividends to their common shareholders. This decision suggests that the company prefers to reinvest its profits into the business rather than distributing them to investors. As a result, shareholders can expect no dividend payments from this company in the foreseeable future. That concludes the financial summary for Abcellera Biologics Inc. Feel free to comment below, and I will be happy to answer them when possible.